Hello, Uncle Jim here. Today I want to share with you how I've been able to generate quite a bit of income selling options during this bear market. I'm going to share with you some put strategies, and I'm also going to share some recommendations of some great stocks that are paying not just great premiums, but also very good dividends. So stay tuned. I think you're going to really enjoy what I have for you today. Okay, now before we jump into the key points of the video, I do want to share that I've been selling options for a while and I've been able to reach financial independence sooner than I ever thought possible. And this isn't something that's unique to me or that I'm some expert at. This is something you can also do too. So I encourage you, if you've never sold options, that you give it a try yourself, and it's not too difficult to sign up. Most brokerages do it. I know Fidelity does it, Schwab does it, I believe Vanguard does it. So it's just a matter of talking to them and getting set up to do the basics to begin with. So that being said, let's actually jump into the key points. So first, before I jump into the put strategies that I like to use, let's talk about what a put is. So in simple terms, a put is options contract that gives you the ability to put stocks to someone. So let's look at it from the buyer standpoint. So why would I want to buy a put? One great reason to buy a put is if you have a lot of shares in a specific stock. Like I have a fair number of shares of Coca-Cola. I inherited them when I was a child. And to protect me from the downside, I'll buy puts. So, say Coke, and I believe Coke's around 55. To protect me from the downside, I might buy some contracts that say 45. So, I don't want to get anything lower than 45 for a certain number of shares. Now, remember though, for put contracts, they're always in increments of 100. So one put contract is equal to 100 shares. Now, on the flip side, which is the side I really like doing, it gives you the ability to really generate a lot of premium, is actually selling put options. And it's like a way of buying stocks. So in the same example for Coca-Cola, if Coca-Cola is at 55 and I want to buy it at 50, I can sell an option to someone at that strike price at 50 and they'll pay me some premium to be able to put those shares to me. So, and that's kind of the basics. What I like to do, especially with my initial strategy, is to do what's called a cash secured put. And it simply means that since I want to buy Coke at 50 and it's 100 shares, that would be $5,000. I need $5,000 or enough cash to cover that purchase of those shares. So, and that, again, that's why it's called a cash secured put. So I always start with that, and then I look for enough premium to be worth my while. And I also look at strike prices where I want to buy the stock. To keep it simple, a lot of times, like in this example I just used, I like to go 10% lower than what the stock is currently selling for. So again, if it's selling for 55, well, I'd like to go down to 50 or a little bit below 50. And I also use something else that makes it a little bit more complicated, but it's called delta. It's just a statistic and it relates to how much risk you want to take. So I use for selling puts like a 15 delta. I try to use a 15 delta, which the easiest way to think of delta is to subtract that number from 100. So, and think of that as the probability. So in the instance of a 15 delta, that would be an 85% probability that the stock would expire outside the money. So in the instance for a put, if you're wanting to pick up that stock at 50 and it never goes below 50, then it's expired outside the money and it just expires and then you can open up another one. And that's where you can really make a lot of money. You just keep selling these puts every month. I sold them more on a monthly basis till we hit the bear market, especially the extreme bear market that we've had over the last month. But once and we may already be out of the bear market. We really had a good Monday and Tuesday, but no one can really predict that. We could drop the next 2 days and then be about where we were before and right back into bear market territory. But once we're out of the bear market, it'll go up fairly quickly. The market will go up fairly quickly, and at that point, I'll probably start doing more monthly And I'm thinking that's probably going to happen later this fall or early winter. So again, I'd start with a cash secured put. Now, while I'm doing that, and I'm going to have an example at the end of this, so stay tuned to the very end of the video where you'll see this in action. I also will look to see if I could buy a put farther out and for a lower price. So let's use that example with Coca-Cola. So if it's $50 is the strike that I'm selling, I might buy a strike at $40, as long as it's inexpensive. Sometimes you'll see, and especially recently with the bear market, a lot of people buy puts and they can get quite expensive. So if it's too expensive, I won't buy it. But if it's not too expensive, I will. And that way it protects me from the downside, and you don't need as much margin or cash. To give you again, let's use an example. Coca-Cola, the short strike is 50, and you buy a put at 40, then you only need the difference in that spread, which is $10 to 50 minus 40, and then again times 100, which would make it $1,000 minus any cash you bring in. So if we brought in $100 worth of premium, you would only need $900 of cash in your account. So, and that's what I typically do. If it's an inexpensive stock, then again, a lot of times I won't buy the outer, but during the bear market, I've been looking at that because I have had stocks that have been put to me and then it's actually gone below that put value or the put strike that I purchased. So, and I'll again regurgitate that at the end of the video when I actually show you an example. And then next, I kind of feel like when you're working during a bear market or you're selling options during a bear market, it's almost like doing dollar cost averaging. Bringing in the cash that you're still able to make. And if you keep selling them at lower and lower prices, it is a lot like dollar cost averaging. And then if you, do have some get assigned and you purchase the puts farther out and at a lower price, they can protect you on the downside. So if the market drops even more, it's really hard to get the bottom of the market, but and that's where dollar cost averaging comes out. And if you're not familiar with dollar cost averaging, it's simply during a bear market or a recession or a down market, you just keep buying more and more shares each week or each month during the downturn. And again, you can do the same thing with selling options. And I also encourage you to, at the same time that you're selling puts, you'll have like rebounds. You'll have bear market rebounds like we had earlier. I believe in July it was kind of a rebound, where you can continue to sell calls too. I won't go into details about calls. I'll have another video link up above where you can actually learn more about selling calls. But between selling puts and selling calls, bringing in the extra cash and then dividends, I primarily invest in high paying dividend companies. Now, there are some that don't pay high dividends, like Apple and Google and some of those. But those are the exceptions, not the rule. The rule is more that I like good companies that pay good dividends. And I'm going to share with you two, again, at the end of this video, two really good companies, neither of which I believe I've shared before. So, and those are the ones I'm actually going to sell a put in for one of those. I haven't chosen which one, but when we get into that part of the video, I don't even know, since I haven't done that part of the video yet, but you'll be kind of experiencing right along with me, which one I choose. And then another important thing, or that does occur, is when the market goes up and down like it does, some of the positions you currently have become very profitable. I typically like to close positions that are 85% profitable. And you may be saying, well, what does that mean, profitable? So if you bring in, say, $200 of premium in an option you sold, and to buy it back, it would only cost you $50, and that's 75% profitable. So in the same example, if I made $100 and I could buy it back at $10, that's 90 profitable. So I find that it makes a lot of sense to also buy back any of the positions that you might have, puts and calls, during these crazy up and down times. And I've been able to buy back quite a few, both puts and calls. So something to keep track of. And it also allows you to bring in a little bit more cash, because if you're able to close those at the best or most optimal time, then down the road you could probably sell additional options again at the best time or the most optimal time. And then before we jump into the actual example, I do want to mention I do have Patreon memberships. They'll be down below, and I've recently changed them. The more expensive membership actually includes a weekly call of 15 minutes where I work with you and help people. And I'm actually working with several people now, and it's I think it helps them with running things by me, and they ask questions they don't get to ask, and we do it through Zoom, and it works out quite well. So I encourage you to take a look if you're interested. And as always, please subscribe, hit that like button. And with that being said, let's jump into the next part of the video. Okay, now I've opened up my Schwab account, and the first of the companies I wanted to talk about is Eastman Chemical Company, and it's down some today. It's closer to its 52-week range, or 52-week low, and it's got good numbers. It's been hit pretty hard. It's down almost 25% since the beginning of the year. Let's see, 5 years. It's probably in its lower range for the 5 years. What about 3 years? Same thing, actually. It's the only time it was lower was during the 2020 downturn that we had. It's still got, so it's 20-day, it's way below its 20-day, 50-day. It's way below all of its moving averages. Now, if you look at its numbers, it's done quite well. Its earnings have been good. Let's look at its, so it's had pretty good earnings. Let's do this yearly. So it's down a little bit. 2022 will be down a little bit from 2021. And its revenue looks good. Its cash flow, I believe, is pretty good. Let's look at its dividends. So it's paying nearly a 4% dividend, which is really nice. And let's jump into details about its dividend. You can see it's increasing it quite a bit every year, going all the way back to 2014, which is probably farther back than that. That's pretty much what the graph shows here. Let's see. So it's got a dividend coverage ratio of 318, so it's got plenty of cash to pay its dividends. And you can see its 3-year growth rate, 7%, 5-year, 8%, 10-year, 10%. So it's quickly growing dividends, which in my mind is really important, because I'm a dividend investor and I really like the dividends. So Eastman is one company I'm definitely looking at and I like. Let's look to see its ratings. It has an outperform. It's also got Morningstar rates at really high. So it's got good ratings. Let's come down and look to see how its debt looks. So debt looks good. It's down a little bit lower. It looks like they've been paying off some debt. So here, 5.15 billion. Yeah, so they've been paying down debt. What about equity? It looks like they've been paying down the equity too. It looks like it's a little higher than it was back in 2017, but it's definitely lower than it was last year. So all good numbers, good company to potentially invest in. And again, with a 4% dividend, if you pick it up even cheaper, say you pick it up in the 60s, you could potentially have almost a 5% dividend. So now the other company that I wanted to talk about is MDC Holdings, and it's trading around 29.57. It's also near its 52-week low. It's been beat up pretty hard. Yeah, here you can see the graph. That's 1 year, that's 3 years. So it's almost to the point where it was. Um, yeah, I mean, the last time it was this low was back during 2020, during the big dive in March of 2020. What about 5 years? Yeah, so here you can see it's pretty low. Pretty good value. It's been, how much down is it? It's down almost 36%. So um, and then if we look at the 20-day moving average, it's, what's the price again? It's 29.57. So it's right at its 20-day moving average, and it's below its 50 and 200-day moving average. So a good chance you're going to get this at a really low value. Now, here you can see the earnings. It's been doing really well earnings wise. It did miss, I guess, didn't miss, but yeah, it missed earlier in the year. Let's look at it for the whole year. Yeah, so you can see its earnings are up quite a bit. So 22's up significantly over 21 and 20, and its revenue looks good. It's got a lot of cash flow, which you'll see when we look at dividends. So now if we jump in and we look at dividends, um, it's paying a 50-cent dividend. So at the current price of 29 with a $2 dividend, and it increases it, I believe it's nearly a 7% dividend. So let's actually dig into that a little deeper. So here you can see it also recently has been increasing its dividend. It has, I think, one more to give, so it'll be $2 for dividends this year, which again is significantly higher than last year. And then let's look. So 513. I'm not sure I've ever seen such a high coverage ratio, meaning they've got tons of money. They're only using 20% of their cash to actually be able to pay the dividend. So there's no risk with them not paying the dividend. I mean, never say never, but very, very unlikely. So of the two, with this kind of dividend, I really like MDC. So I think I'm going to focus on it. Now, I don't know why Market Edge is giving it a void. Everyone else is saying hold. But there again, it's got a B rating from Schwab. Actually, let's see. Let's look at its numbers. So debt, it has increased debt a little bit, so that may be a little bit of concern. Total liabilities, so it is up. It's got a little bit more debt, and then its equity is a little higher, so might be of a little bit of a concern. If they didn't have so much coverage for the dividend, I'd be a little bit more worried. But they're a well-run company and they do pretty well, I believe. And if you sell a put and you can actually pick it up at a much lower rate, like I would be hoping to pick it up around 22, which would be close to an 8 or 9% dividend rate. So at 22, yeah, it would be almost an 8 to 9% dividend rate, which would be really good again because I really like the dividend. So it's not just making premium with selling options or with selling puts. It's also related to earning some good dividends, especially if I end up owning it. Which let's actually jump into take a look at the option chain. So if we come here, so and again I want to pick it up at 22. So here we have the 17 dividend, or the 17 delta, and at $25 it's paying between 55 and 70, and that's expiring in November 18th, so not very far into the future, which is nice. It does have a 40. So like I mentioned earlier in the video, if you look at the bid and ask, and typically it's the ask that you're going to end up having to pay if you want to buy it, especially if you're doing a market order. So it's not inexpensive at 22. Let's actually do all. So 15 at 15. So we could do a 25.15, which would give you about 40. It's still a little pricey. So let's go a little farther out. This is December 16th. And again, I'm looking around a 15 delta. So these deltas are kind of interesting. This one's 17.13, then 14. That's interesting. I've never seen that before. It may be because of this $1.25. Someone's trying to make a pretty penny with offering it up at $1.25. So that's what I meant in the sense that some people are causing the what you have to pay for the puts to be a little bit squirrely. But again, I'm going to primarily do this as a cash secured put. I just like looking at them while I'm here. So here's a 17 delta or a 13. The 17 delta I could pick up $70, which isn't bad, and it would be at $24. But again, I want to kind of get it at 22. Again, with the bear market, I'm trying to keep the risk lower. And if the stock recovers and it goes up into the high 30s or 40s, then this will become very profitable. But let's go a little farther out. Now, this is closer to 6 months. It's actually 5 months, I believe. And at 22, it's a 16 delta right here. You can see and for puts, they do it as a negative. But again, I always, so in this case, I would say it's a 16 delta. I wouldn't worry about the 2, and I typically remove the negative sign. Like over here, these are calls on this left side, the delta, which is over here. This would be like an 82 delta, meaning it's 80. It's already in the money, so the probability it'll expire in the money is really, really high. So calls I typically will do. So if we come down here, I'll do a 20 delta, which is right here. So 39 is like a 20 delta. So I just wanted to share. The reason they do it is a negative. It's just the way it works with puts. So I'm looking at this 22 delta, and I would pick up a dollar, $1.15. And again, if the market recovers, most likely it's going to come way above the 22, because 22 it's like its 7-year low, and at $22 it would be paying almost $9 in dividends. So if the market tanks majorly before the end of the year and goes down significantly, well, if I get assigned at 22, I'd be okay with it, with earning those kind of dividends. So what I do here is I will hit select, and then I'll come back up, and then click trade over here, or I could switch it back to puts. So so either way, I can click trade here, or I can go back and say puts, and then come back down, and it should still be marked. Yeah, right here, and then I could say trade. So, and this is where you can see it pays between $1 and $1.15. So at this point, what I would do is look at, well, I would change this, and I would say sell to open. So if you're selling an option, you always do sell to open. Now, if you close it, it would be buy to close, and it's sell to open for both if you want to sell puts or calls. And here you can see it's a put, and I'm doing one contract, and I should get between $1 and $1.15. I typically like to do market orders, so it should bring in $100, which is nice. Now, there may be price improvement, which we'll see that when we get the status. So what that's telling me is I'm hoping someone will pay me $100, which they will. Again, doing a market order, they almost guarantee that you're going to get this bid value here. That someone will purchase my put at a 22 strike expiring in March 17th, 23. So let's actually scroll down. Let's review the order. So here it's saying $100, 65 cent fee, which I'd pick up 99.35, which is what I want. And I'm only going to do one contract at this point. Um, again, with it potentially we're not out of the bear market. We might be. Again, you don't really know till after the fact. I'm only going to do one for today. I typically try to earn around 700 a week, and I believe I'm about $100 from that point. I think I've already earned 600 for this week, so this would get me to the 700 range. And I want to make sure I'm in the right contract. And let's say place order. So it's sold to open. Let's look at the order status. That's something else. Let's look at today's. And there it is. So I got 100. I got the dollar. So I got $100 for it, or a little bit less when you subtract the 65 cents. So that's it. That's how it works with selling an option. And again, I do this. I sell puts on stocks I want to own, and then once I own them, I sell calls on them. So if I get assigned with MDC, then I'll actually sell cover calls, meaning with a cover call you own the shares. So on the flip side, I do both, and it works out quite well, especially with the market going up and down the way it does. So as always, if you have any questions, please put a comment below. I try to answer all my comments. If by chance you know, I I don't think I've ever missed any. I did have one person say, "Hey, you didn't ever answer my comment," but I couldn't find his comment. I think it must have been blocked by YouTube or something. So that's it. I hope you enjoyed it, and I hope you have a wonderful day. Thanks for joining me.